With me now is Raamdeo Agrawal of Motilal Oswal Securities. Needs no introduction. As a part of his annual exercise, he's written the 21st Annual Wealth Creation Study. This is the report, and this report is different from the previous 20 reports because they were focusing in on what to buy, how to select a stock to buy, but this focuses in on the weightage or how much should one buy. Thank you so much, sir, for taking out time for us. Could you just explain our viewers about the 21st Annual Wealth Creation Study and why is it different from the previous 20 studies?
Yeah, so first 20 we did on what to buy, fundamentally how to pick up a stock and within them what to find in terms of characteristic. But we said let's do a little more in terms of what it takes to make money in the market. So there are two fundamental things in the market. One is what you buy and second is how much you buy. Because in 100 rupees, you can buy 20 stocks of 5 rupees each, or you can buy 2 stocks, say 5 stocks of 10% each, and then rest of the 50% you can decide to put in 15 stocks. The outcome will be very different. So how do you see, because your money is there, you want to manage $1 billion or $2 billion or $5 billion. How many stocks you want to buy and how much each stock should have? That has a huge bearing mathematically on how much money you make. So we said, let's look at this subject, how much to buy in this particular study. And we went about looking around for ideas. How do you, globally, is there any set idea about this particular thing? And we realized that academia is very, very poor in this. There is very little written and there is not much of literature on how much to buy. Everybody practices its own way, Like somebody will do 100 stocks with 1% each, or somebody will have 100 stocks. Out of that, top 20 will have, say, something like 60-70%. You'll have a huge concentration in the top 5, 10, 15 stocks. And then there'll be a long tail where 0.5%, 1/4%, even 0.1% will also get a mention in this thing. So that's one style of deeply diversified. Then you have the likes of the masters like Buffett, Munger, Keynes, and so these guys, they have gone about concentrated investing, which is like 3 stocks, 5 stocks, 10 stocks, less than kind of a 10 stocks. Buffett says that you need not go beyond 80 stocks if you know the stuff what you are buying. And there should be a gap between number 1 and number 8 also. Within 8 also not equal weight, not 12% each. But number 1 should be more like, top 3 stocks should be more like 70-80% types, So basically, so they have done very well in the past. So there are things to be learned. So when we look for the framework, where is the framework for how much to allocate? Then we found that Kelly's formula. Kelly is a scientist in Bell Labs in 50s. So he had given some formula for bet sizing in casino. But casino situation is very different from stock market situation, but that became the cornerstone of this study.
So say if you have 10 names that you like in the market, and say top 3, as you said, are the top conviction. You right now are not invested and you have 100 rupees. How will you determine the top 3 names and what will be the percentage allocation? How will you determine that?
Yeah, so even earlier also we were doing the same thing. We were never very diversified. We always had 15-20 stocks. So, but then allocations were not that scientifically decided. So most of the time what happens is you buy certain stock and when it does very well, that 4% becomes 8 or 9%, right. And then you are pretty happy with that. Rather than starting with 8-9% and making
taking
that
16%.
Yeah. So so in PMS to some extent we have done, but in mutual fund in any case the restriction is of 10%. So there I think the opportunity to allocate more rationally is there because it's one single portfolio. So what happens is that you can decide to buy for all 100,000 people or 200,000 people simultaneously. So in this, the allocation for top 10, 3 or 4 in top 10 could be, on the basis of where exactly you feel. See, like you take interview, out of 5 interviews, 1 interview has gone better than others. So we have to figure out where exactly you think there is a asymmetric payoff going to be. As and when you realize, if you don't realize and it turns out to be asymmetric, you can do nothing about it. You will remain, say, equal weight allocated. Say 10 stocks means 10% each. But if by chance you realize that this stock is going to be much better than others, then you must up the ante and buy a lot more. And in fact, you must try first to create more edge. Understand that particular situation more deeply and increase your edge over the market. Now, what is the edge over the market? You got to, your edge over the market is, this is efficient market. It's broadly, markets are fairly efficient because thanks to cable channel, internet and companies' own disclosures and all and quarterly results, market broadly knows 98, 99% of the information. There will be 1 or 2% which market has missed out. So you have to know a lot more than what market knows. And at the same time, you must also know what that price has built in. I mean, how much the market knows, that you must know.
Right.
Because then only you can figure out the edge, that you know more than the market. And when you know more than the market, that's where once you reach into that situation, that is where the research plays a major role, and your own hard work, the framework, that comes into play. And when you realize that you have an edge, you start allocating more.
Right, but it can even work the other ways because a lot of things change. So how essentially one has to keep updating the data? As you said, you can allocate 5%.
Yeah.
The stock probably doubles or triples, it becomes 12% of your portfolio. Then the PEs are high or expectations are very high. Plus at the same time, things like demonetization which have happened could suddenly change the business. So how essentially do you now take that risk of 12% and then start to trim down position?
So it's a very dynamic thing, and I mean, we are also in learning process in the sense that how exactly to apply. We have been doing it on a constant basis because in mutual fund you have inflow, outflow on ongoing basis. But I would think that every quarter you get the full portfolio results come. You must do your analytics every quarter at least, and we have the discipline of doing the on a 3-year basis analytics, and on a quarterly basis, and of course 1 year also. So 3 months, 1 year, 3 years. So we keep looking at things on that basis, and when the results come and when you are meeting the management, when you are interacting, when you are reading some book somewhere, you start getting a lot more confident about the future of a company than some other companies in a portfolio. So I would think that it's life is almost on a daily basis, but for a portfolio manager. But quarterly, of course, the discipline must be there.
Right. We can just take an example of Bajaj Finance, a great success story.
Yeah.
But if you just look at the returns, I mean, in the last 18 months, it's really just gone up. So if somebody was patiently waiting with great amount of allocation to it, can it sometimes become difficult when a stock is just discovered?
See, this stock market is crazy place. What happens is that once you start seeing that this earnings are kind of accelerating, clearly you know that the stock is going to do well. Okay. Now, what happens is in the next 2 or 3 years, the stock goes up by 40, 50 times. I have seen stocks, many stocks going up by anywhere between 10 to, Bajaj Finance must be up by at least 50 times in 3, 4 years, 5 years. Okay. Now, earnings have also grown, earnings have not grown that much for sure. Earnings have grown much lesser, maybe 10 times. But stock has, because of re-rating, stock has gone up by 5 times.
Right.
Now, in that situation, you don't know how much of the future growth has already been built into the price.
Right.
And that's where the main problem comes, because the successful stocks, you tend to overstay. And actually, despite good performance, it underperforms because the expectation built is much higher than what it performs. Say, stock company does 30% growth in the earnings, but actually in the price, you are expecting 70%. So 30% is far lesser than what market was expecting, and hence the stock will not do well, and you will suffer, your portfolio will suffer. So your own success becomes a curse. So that overstaying starts. So howsoever vigilant you are, when to sell comes into play, but then at the end of it, if there is a second lease of life, because company is growing at 30-40%. So one of the rule we have is, don't come in front of a speeding truck. If the earnings are growing at 30-40%, even if it is slightly expensive, in a year's time, 6 months' time, these stocks will correct itself, and then they'll find new wave of growth. So have some patience and wait for the stock to correct and get again pace with the earnings. So I would think that it's a very challenging work. In a situation where you are successful, where you are unsuccessful, actually things are much easier. You can say, okay, this is not working for me. Let me, in next 6 months, 1 year, 2 years, whatever holding period. And after that, if your hypothesis is not working, you can move on to the next one. But the one where it has worked and worked brilliantly, I think I have personally suffered a lot in overstaying in a lot of stocks, and many people are kind of holding a lot of stocks of theirs which are hugely successful in last 10-15 years, hoping that same kind of repeat thing will happen in next 10-15 years, and they just hanging on. I'm a real estate. I think it is 10x or 15x in Delhi or Mumbai or many places. A lot of people are hoping that same kind of repeat thing, say something was 10,000 rupees, that has become a lakh rupees per square foot. Now they're hoping that a lakh rupees will go to 10 lakh rupees, which is just not going to happen. I mean, for ages, maybe 10 years, 20 years, it might be a history.
Right. So, whenever we've done the value creation theory or the wealth creation theory, one of the key things is that don't hold on to your mistakes, because they just tend to go down and down every time. So it works exactly the other way around as well.
So there are two types of allocation mistakes. One is of course you don't buy enough, or you buy the bad stuff a lot.
A lot.
So that's a fundamental mistake. But second is overstaying and understaying.
Right.
Overstaying with successful stocks, and also understaying with successful stocks.
Both are mistakes.
Both are mistakes, because if you cut the flower quickly, say doubled or tripled, and you think that before it goes down, let me sell, and it goes to 10 times or 20 times, then again also you feel very bad. Right. So it's kind of a tricky kind of situation, where to get the top of the growth and last bit of juice out of the stock is very tough. So how do you kind of bring rhythm in the portfolio management in terms of you buy right? That part is separate. You buy right, then you allocate well, and allocate well for a adequate period. So it's quite a bit of balancing.
Right. Always we have also been taught, when we were learning finance in college, that diversification is one of the most important thing. So within 8 or 10 stocks or 7 stocks, what you're looking at, diversification even becomes much more important. So you can only have a one Bajaj Finance and maybe not any other big NBFC.
Yeah, it depends on the portfolio manager. I mean, you can have, sectorally, we say that individual stocks will not buy more than 10%, and sector-wise will not go beyond 25-30%. So you can have, 3 more NBFCs or private sector banks or whatever, financial sector per se. So because all of them are tied almost like whatever happens to the finance sector. So you can have diversification within a sector, and as far as diversification is concerned, as per theory, beyond 15 stocks, 80-90% of what could be diversified gets diversified. Beyond 20 stocks, even if you go to 100 or 1000 stocks, your gains are just about 1 or 2%. So there is no point in making a huge portfolio of more than 20 stocks. Maybe even with 20 you may not be able to do a good job. But as an individual, because portfolio management is a very individualistic effort, as an individual, you will most likely you are going to do a better job with 20 stocks than 40 stocks, isn't it?
Right.
It's simple kind of situation. So my sense is that if you have 15 to 20 stocks, and you will get a lot more time, and individually you can think as an individual about the outcome of every single stock, and hence your analytics, the moment your analytics are saying, or you are feeling yourself that this stock is going to do very well, create an edge, learn a lot more, and then bet big. That's the basic. This is, there are formulas you have seen, BP minus Q divided by B. So, upside multiplied by the probability of upside,
right,
minus downside divided by odds. So basically, it's very simple formula, but when you look at it, because what happens is, what is Kelly saying? See, Kelly, in a casino situation is about, the probability as well as the payoff. Whereas in the stock market, neither the probability nor the payoff. So in that kind of a hazy situation, you only one tool you have is the given price. Facts are with you. You go and find the facts of the company in the research and look at the price. Whether price is reflecting all the facts you have in your mind or not. If you know more than what the price knows, go and buy and make money.
Right, and where the prediction, or where you think the numbers would go, that's where a little bit of judgment would be. That's
what the price should be telling you. Say if it is 80p or 70p, market is telling you that this stock, the company's current profit is must grow at about 40-50% to justify current valuation.
Right.
But if your facts are saying that it may not be able to grow at 50%, actually it can grow only at 30%, or management is guiding with 30%, you better take your profits, because the market is expecting 70% and you are likely to get only 30-35%.
So price will correct itself.
Price will correct itself. It's there fully in price. You don't have any edge. Market is run ahead of you.
Right.
But accepting that market has run ahead of you requires a lot of courage, you know.
Let's just talk about 2017 as well. So, a lot of people, we are getting calls after the recent fall. How should one invest? Say, assuming markets are here around 7,900, 8,000. Most of the allocation should happen, incremental allocation should happen to equity for investors?
I don't know. I'm out and out equity guy for so many years. So I would not, the wealth planners will be able to tell you. But if you look at the situation, there are only two asset classes, I would say, realty and fixed income against the equity. So realty is in shambles, and I think with this RERA and demonetization, I think the worst impacted segment will be realty. And highest I would say, mispricing has happened in the realty side, particularly in Mumbai and Delhi, and particularly Mumbai and all. So I think a lot of correction is to happen. At least time-wise correction will be there more than price-wise. So, as I said, 1,000 rupees has gone to 10,000 rupees, or 10,000 rupees has gone to 50,000 rupees. Now you don't expect the same 50,000 rupees per square foot flat can go to 2.5 lakh rupees in next 10 or 15 years also. So in that kind of situation, one has to be very cautious on investing, because cost of investing in realty is very high. The fund manager's cost, the fraction cost is very high. 3-4% is definitely there. So I don't think people will do very well investing in realty per se. They will not make extraordinary returns. Gold, in any case, is in bad shape. Fixed income, now interest rates are like 5-6%, that to pre-tax.
Right.
So getting 5% post-tax is also becoming difficult. Whereas in equities, the depressed prices are the best time to start for investing. Your chances of making superior return increases as the prices levels go down. So as you said, I think this is the time to start investing in equities. If somebody has never invested in equities, at least start allocating 20, 25%, 10%, 15%, 20%. Start learning the process. Right now, I would think that whosoever invests now for a minimum 3 years, if not for 5 years, I think in 5 years, they have a very high probability of not losing anything and making at least 15% compounded. Double their money in next 5 years. The probability is very, very high.
Right. See, earlier also we were always talking about 15% returns, but now 15%, assuming that fixed income is 5 to 5.5, becomes even more superior?
Yes, because see, ultimately you have to look at what happens is that nominal interest rate is say 5%. So if you're getting 5%, you're getting real interest rate or real gain, real wealth creation is just about 0%. Whereas if it is even 15% in equities, your real income growth is as high as 10% compounded. In 7 years, you'll double. Here in perpetuity, you'll never double.
Right.
So because there your 5 minus 5 is 0, whereas here 15 minus 5 is 10. So I think equity always has been great, but the risk appetite, people are scared of fluctuations, that it will sink. One of the things about equities is that there are a lot of junk equities. Let's not forget that. Okay, that much junk real estate and that much junk gold is not there. Equities is particularly known for a lot of junk stuff. And time is friend of good equities, and time is equally big enemy of bad equities. So make sure that you are not saddled with bad stocks, non-quality stocks. And that's where the making sure that you buy quality, and there is enough quality stuff available. 70-80% of the market cap is of the quality companies. But people to buy cheap, they end up buying some
the remaining 30%.
Yeah, so that's the main problem. They must avoid that. So once you are able to do that, and if nothing else, your indices are also made up of very high quality companies. If you buy just the indices with the ETF and low cost index funds, I think you should do well.
Right. Let's talk about what's going into 2017. So with the last 45 days of whatever problems that we've seen, FIS selling, do you think chances of positive returns in 2017 or second half of 2017 are much higher now?
I would think so. See, it is almost impossible to predict. You see our tape last year, what you recorded. Everybody is wrong. At least I am 100% wrong. That we raised the hope of making 12, 15%, 18%. I mean, the index is, I think, year on year negative. Isn't it?
Just negative.
Just about negative. It went below this thing. So I think there would be hardly somebody who's, by chance, he's right. So everybody is wrong. So I think, if you ask me, I'm right now definitely we are starting with slightly depressed times. And since everybody is very negative about the market, I feel the second half and the overall results for the year, it will not be disappointing. I think a lot of good things are happening in the world economy, and world economy is recovering. We're talking about 3.5% growth for US, 6.5% for China. India is also equally big growth economy right now, slightly below 7%, but 7.5%, 8%. Government is trying continuously to increase the growth rates. So I think commodities are recovering. I think a lot of backdrop is good for, and I hope demonetization is behind us. Remonetization and stimulus in the economy is ahead of us. So I would remain optimist and think that 2017 will end up well.
Right. In terms of sectors or stocks that have not done well, NBFC is one space which again people were very bullish on. They did very, very well before demonetization. And after demonetization, you are seeing sudden selling. Is that just because of flows, or do you think there'll definitely be some problems in operations of these companies?
No, operations, I mean, of course, demonetization has hurt to some extent the immediate collections in 30 days basis, 60 days basis. But I think there was too much of piling on had also been happening in these companies, whether it is MFI companies or so-called NBFCs, housing finance, and also I think there was a bit of over buying which had happened. I think that is getting corrected, and not only in them. I think the entire market is getting corrected, because the P multiples of a lot of these mid caps are really very, very high. So that correction is on, and hopefully, once the correction is over, then the same companies will do well. And I think 2017 will also see re-emergence of some new sectors.
Right.
People's attention are one side, and emergence will happen from some other side.
Right. Even demonetization per se will bring up a lot of sectors, a lot of organized business which were not doing so well earlier, but probably FY18, FY19 could be great years for those sectors or companies.
I think whatever we have seen so far in the early recovery, if you see, say, Maruti is coming back, all the car companies are not doing that well, So my sense is the companies which are better organized, which are bigger, which are much more stable, proactively they can tailor to the needs of the time. I think the well-organized companies will come back. Actually, the quality will do better. A lot of unorganized companies or smaller companies, they will fall on the wayside. And if GST also comes, so you will see a lot of consolidation happening, and competition become consolidating into well-organized retail players.
Right. You've always been one of the few investors who have liked organized retail play. Just let's take an example of Havells. We spoke to the management. Now, they told us after demonetization, yes, there has been a slowdown, but inquiries have started to pick up. But at the same time, even they were unable to judge that, what is the sort of impact of unorganized market. So do you think Q3, Q4 numbers or maybe Q1 numbers of FY18, that's when, good organized retail business could do very well? Or we'll have a clear picture of what will be the growth outlook there?
I don't know. I mean, the first time we are going through demonetization. See, I think it all depends on the pace of remonetization. How fast the system gets remonetized. If it gets remonetized by, say, end of January, I think even in February, March, you might see a much more vibrance. Because there is, nothing else has changed except for the liquidity in the hands of the retail people, whether it is a village, there is tier 2 towns, tier 3 towns, or the larger denomination like 2000, so illiquidity is there. Some of the purchases get deferred because of that. But I think largely that should be sorted out in next 30 days. Once that is done, then I think the way we used to feel before November, there was almost a bull run kind of thing, all the automotive purchase. I think that will come back with vengeance. Whatever deferred 2 months purchases are there, what is durable purchases, they will come back. I think a lot of stimulus in terms of a lakh crore or something in laundering, what must have come in the hands of a lot of people, that will come with a high purchasing power kind of situation. So it looks that post-January, or maybe starting from January itself, we might see a V-shaped kind of recovery.
Right. Going into this budget, there are a lot of expectations that for individual tax brackets might be increased, for corporate tax rate might be cut quite significantly. All that, even if it is done in a very phased manner, or if the direction is on the positive side, could have a big impact on these organized retail players?
Not organized. See, I think the government's intention right now, main fight government has is with the black money. Okay, so they have tried the, they are trying the stick, and they must keep on with the stick. But I think how much carrot they can do. See, cost of evasion has to be increased. Okay, so there are two ways of increasing the evasion. One is by stick. You find the guys, punish them, put them behind the bars, punish them, whatever you do. Second is just lower the tax rate also, and rationalize it. Make the life easier for them to pay and get away with that. So, you can never eliminate 100% of these crooks, but can we win over 40, 50, 60%, 70% of the people and get better tax compliance and better spread of the compliant people and increase the tax to GDP. I think the real challenge, I don't think India's story will ever take off unless our tax to GDP goes up. Whether it happens by stick or whether it happens by carrot or happens with the both of them. So unless your tax to GDP climbs from 10.5%, 11% to more like 14, 15%, it will be very tough for the government to muster enough resources to pay for the infrastructure and all.
Right. Just a word on pharma and IT, and I particularly want to ask this because they don't get impacted by demonetization or remonetization so much, particularly, especially IT, and valuations over there have also corrected. So right now they are just, because markets are subdued, you're seeing selling pressure, they may bounce back for one or two which have US FDA problems, of course not them. But apart from that, do you think these are sectors which are now looking attractive?
Clearly, looking at the valuation there, and there's a lot of confusion. But these are sectors where you have a global competitive advantage. There is no alternative to Indian IT, there is no alternative to Indian generics. Whatever is the growth pangs right now in terms of global economy being slow, a lot of business models are changing, everything is going into the cloud. So your old model, headcount driven model is being challenged. So those issues are there, but basically both the industries are very stable and very profitable. And at 69, 70 rupees to a dollar in a weak currency situation, they are particularly beneficial. So clearly, and valuations have corrected a lot. So wherever you see opportunity that these companies are clean, they are not challenged by the current whatever is going on, those companies will do very well. Right.
Raamdeo, just a last word for our viewers. They always look for ideas from you. I know you cannot talk about stocks, but any sectors where they are looking to research where you think that could be outperformers in 2017, maybe any two where they can
17 is tough to say. Yeah, 17 is very tough to say. But longer term, 3 to 5 year basis, say private sector insurance, that's going to be a very large opportunity. Very, very large opportunity and very high quality opportunity. Because in insurance, unlike in banking, insurance has all the benefits of value migration and private sector, and consolidation is a lot more compared to banking. So of course opportunity size is also smaller and is far more regulated than banking. But since the competition is lesser, I think going forward private sector banking, private sector insurance opportunity could be pretty large and very long term, in the sense that some opportunities are cyclical, some opportunities are for 2-3 years. This is an opportunity for much longer period, So that one looks to be, and they could also be beneficiary of this demonetization, where a lot of savings products, financial savings products, are going to be kind of, I'm just hoping that allocation to insurance or other savings products, they increase significantly starting from January. But even otherwise, I think insurance has a lot more opportunity. That looks one segment. One must wait for the newer opportunities to emerge. Clearly, something will give in the sense that, let's see what comes out of this entire exercise and what does government do with the resources which they get in. Is there infrastructure spend going to pick up? So can we buy some capital goods companies? So I think it's a wait and watch. Opportunities, they keep coming. It's not that today only we have to look at it.
Raamdeo, thank you so much for taking out time for us. Hope our viewers learned a lot. I did. Thank you so much.